welcome back to the last session today of Ensuring Success 2022. We are live in Dallas and hope that you're enjoying all of the thought leadership and education that we're offering today. There's another whole day of it tomorrow, so plan on that as well. I am Gail Perry, CPA Practice Advisor, Editor-in-Chief, and I would like to mention right now our sponsors who are making this event possible and giving you the opportunity to earn up to 14 hours of free CPE, and that includes ADP, Avalara, BotKeeper, CorpayOne, CPA.com, Caseware, Canopy, Field Guide, eFile for Biz, Intuit, Right Networks, SafeSend, Sage, SureLink, TaxFile, Tech Guru, Zero, and Zoho. And I assume you heard that this, or noticed online that this session also does qualify for IRS CE credit, for those of you who need that. This particular session is sponsored today by TaxFile, and you'll be hearing a little more from TaxFile during the session itself. I'd like to explain how CPE works in case you're just joining us for the first time today. We will, at 3 points during the session, we will break and display a code at the bottom of the screen, and we will alert you to that code with this sound. So when you hear that sound, write down the 3-digit code that appears on the bottom of your screen. There will be 3 of them during the session. That gives us assurance that you stuck with us for the whole time. And then after the session, after tomorrow, next week, next summer, whenever you want to, you can go to the Get CPE Credit option at the top of the screen. CPE and CE credit, you just go to that and fill in the form, the form that appears, and use the numbers that you collect in these sessions. You'll click the Go button next to each session that you attended, and then the Download button, and you can download your CPE certificates right there on the spot. We will be submitting your CE information to the IRS. I'd also like to mention we are on social media today with hashtag #DecemberCPE, so we would love for you to chat about us on social media. And one other thing, there's a Q&A box. It's called Ask a Question at the bottom of your screen. If you have any questions for our speakers, if you're having any tech difficulties, if you'd just like to say hello, feel free to post in that Ask a Question section and we will find it there. All right, this session is on tax credits that are available to parents. And our panel includes Nadia Rodriguez, Justin Watkins, Kelly Welter, and I'm joined by my co-moderator, Alexandra DeFelice, and I'll have each of them introduce themselves right now. Nadia?
Yeah, thank you, Gail, for having us today.
Sure.
Nadia Rodriguez with Intuit, Tax Senior Analyst Programmer.
Hi, my name is Justin Watkins. I'm with TaxFile.
Hi, my name is Kelly Welter. I am a sole practitioner. Actually, no, I have a partner. I'm not a sole practitioner. I'm a small practitioner in Las Vegas, Nevada with the firm Searle Kiefer Welter, and we primarily work with small businesses and individuals.
And I am Alexandra DeFelice, Director of Marketing and Business Development for Payne & Fears Law Firm in Southern California, and co-moderating today and tomorrow's sessions with Gail.
All right, thanks everybody. So, if you have children, or if you have clients who have children, you're probably aware of the plethora of tax credits that are available. And in addition to being on top of all those tax credits, you also need to be on top of the fact that most of them have changed this year and have been in flux for a couple of years in terms of post-pandemic changes that have made new tax credits available and have adjusted the ones that are out there. So we'd like to kind of give you an update of how to advise your clients who have children, or if you're in that situation yourself, things that you need to know about your own tax situation. So let's start with, which I think might be the most complicated part of all this, which is the child tax credit. Can we talk a little bit about what that is, how it was created, and what has changed in the past year? That's a lot to talk about.
Basically, everything goes back to what it was for 2020. Anything that happened in 2021 regarding this is a non-issue. And that's the biggest thing as a practitioner is you need to reach out to your clients for planning purposes to let them know maybe the refunds that they received in 21, those are going away because the numbers have so drastically changed. And they need to prepare for that or they're going to have some surprises in April.
So what are the specifics of the credit?
And that's right, Kelly. I mean, the conversation that you're going to have with your clients now might be around the same time that you had last year, the same amount of time, but it was in a different direction this year for sure.
Right.
Now it's not going to be as generous, those refunds. The credits in 2020 were a child tax credit of $2,000 per qualifying child. We had a nice generous bump up to $3,000 or $3,600 depending on the age for 2021. Now we're going back to the 2,000, what we're more familiar with. Now us as practitioners, I think we're familiar with those numbers. The taxpayer on the other side, it's not going to be a good news for them, you know. So yes, we do go down to the $2,000 per qualifying child. And I think also the qualifying age,
Right.
now it's going to go back to they have to be under 17.
Right.
Where in 2021, it was they had to be under 18. So I think most of that is maybe not so no good news, but back to what we were at 2020.
As well as the additional increase in 21 that they had up to $3,600 for kids that were 5 years and younger. We don't have that anymore. There is no difference.
And what makes a qualifying child for this credit?
Yeah, so a dependent, right, under the age of 17 now for 2022. So that has to be definitely the age requirement.
And what else goes into the whole test for qualifying child?
So there's a slew of them. There's 7 tests for the child to qualify, which is the age, relationship, dependency, residency, financial support, citizenship, and the income test. So there's a slew of them, obviously, that have to be met in order for the credit to be applicable. The main takeaways, though, is basically the financial support one is a big one where you have to provide the child with more than half of their support, right? And obviously the child has to be a U.S. citizen, permanent resident, or national. Generally, the child also has to live with the taxpayer for more than half the year. So those are the big items. One of the big things that I'd also like to mention too is one of the big changes that is going to be a huge impact to the return is the refundability of the child tax credit. So in 2021, what they call the additional child tax credit is refundable up to $1,500, whereas in 2021 there was no the credit was fully refundable. So in that aspect, what that means is, you know, if the taxpayer owed no tax or very little tax, this child tax credit could either produce a refund or could increase the refund that they were already due. So that's a significant change from 2021 going now into 2022.
So it's not refundable at all in 2022?
So it's partially refundable.
Partially.
Up to $1,500.
Up to
Okay,
$1,500.
got it.
But the other big thing that happened in 21 that we're not seeing this year is that people started receiving money each month starting in
Right.
July through December, and it was called the advanced child credit. That didn't happen. That went away. It ended in December 21.
Okay.
So that will partially help because that even allowed for some surprises. People didn't even know they were getting them in 21. They just saw money showing up in their accounts, which no one disagreed with. But it did have some, you know, kind of reconciling effects when we were doing the 21 returns. So on a plus side, that might help people this year that, you know, that saw some differences, but
Yeah.
we'll see.
So last year people ended up having to pay some of that back, right, if
Some of
their
it,
income was too high? or
if their
whatever.
income was too
Correct.
high, right.
That's a little complicated.
Yeah,
Oh,
so I know on the
yeah.
form, right, on the 8812, we had that third page that was new with the reconciliation and then whether they had to pay some of it back.
And
So-
it held up a lot of returns.
Yes.
Because people, like I said, didn't even know they had received it. They didn't have the correct numbers in there. So it would hold up the processing of possible refunds because they weren't using the correct number.
Right.
Yeah, they had to go hunt for that letter.
did.
The letter to provide that reconciliation. So I think, like Kelly's saying, the plus side is not having to keep up with
Right.
hunting down those letters, and it's just back to what we were used to in 2020.
One other intricacy of this, is there any issue for married filing separately, or divorced couples, or who's claiming the child dependency exemption, or who gets that credit?
So
Whoever's got the exemption?
You know, there was that with 2021, I think, too, also came with those married couples filing separately. It was also who received that advance payment for those 6 months, and then the reconciliation had to happen. Now we're back to 2020, where whoever claims, you know, is entitled to claim the child is the one that receives, is entitled to the child tax credit.
Okay.
But that was a huge issue, especially if you had families or parents that would do every other year,
Yeah.
because we weren't exactly sure when the IRS was basing their numbers on, if they were basing them, some said 19, some said basing it on 20, and it
So they might have paid the advance credit to the wrong parent.
Exactly. And I still don't know how the IRS is figuring all that out. I don't think they know at this point. So
It could be. Yeah. All right. We would like to take one moment to have you look at the bottom of the screen, and we will post the first CPE code for this session. So be sure to record that number if you're planning on receiving credit for this session. Okay. Let's move on a little bit to the Child and Dependent Care Credit, which has also changed from last year to this year. So what has happened there? There's some big changes on that.
I think this one hurt me personally with my kids. I mean, the daycare expenses, the after-school programs, they're not, you know, they're quite up there in cost. So it was really good news for 2021, and only 2021, where, you know, this credit, you compute it based on a percentage of those qualifying expenses that you spend on the dependent care. It went all the way up for one qualifying child in 2021, and only in 2021, up to $8,000. And, you know, that's still probably not enough for the whole year to pay for daycare, but it was a nice increase. Unfortunately, now for 2022, we're back down to $3,000 for one qualifying child. Now, if you have more than one qualifying child, it's up to $6,000. And the way you compute this credit is a percentage of those qualifying expenses. So that's another downfall for 2022. We go back down, right, to 2020, how it was. It's at 35%. Of those qualifying expenses. So for example, one qualifying child, if you spend up to $3,000, it's 35% of the $3,000. 2021 was a nice 50% up to $8,000. Okay. So yes, it's going to be a different scenario, but not unfamiliar, right? We go back to 2020, how it was.
And the other big issue was that it was fully refundable in 21. 21 was very nice and friendly.
Nice, generous
yes,
year.
it was very generous. It goes back to being non-refundable in 2022.
Yes.
Okay.
Yeah.
Is there, and I don't even know if this, is there any impact on, so if you're an employee and you're getting child credit benefits from your employer, how is all this impacting that? Or because, so before you could write off or basically equate the child benefits from your employer with whatever the credit might have been, but now if the credit's lower, is that, if your employer is paying you the same amount, is that going to be taxable? Do you know what I'm saying?
I would assume the employer and the payroll companies are adjusting like they did. Not all companies did. Not all payroll companies did last year to increase the contribution that one can put into a dependent care FSA. But I'm assuming they are for 2021 that's something they're adjusting. But I mean, that's a great point for us to look at those W-2s when they come in for 2022. Is it up to the limit of the maximum of how much they can contribute?
Right.
And this is because they can be taxable. And what we see is, especially again on divorced or separated parents, there may be one spouse that is taking that dependent care benefits and their W-2, but they may not be claiming any kids as dependencies. So you have to pay attention to that to make sure it's all recorded correctly. And we keep talking about kids meaning daycare or summer care, but you can also receive this for elderly care or adults
Right.
that have physical or mental disabilities. But again, both parents need to be working and have earned income to be able to do that. People
Okay.
forget about that, and it's becoming more and more of an issue.
Yeah. Are there any other rules regarding who you can claim that have changed from one year to the next, or is it just the amounts that have changed?
I think the biggest difference is probably the age on the qualifying child.
Okay.
Other than that, it's the same, the dependency test. It's back to, it's always been the same dependency test.
Okay. All right. And when we were prepping information for this column, by we, I mean you guys, not me, for this session, I mean, there's, next we have a credit for other dependents. So, which is that new this year? What is this? It's on this list.
Oh, yeah. No, it's not new, just to call out that if you do have a dependent that maybe does not meet the age requirement, they might fall into the category of claiming a credit for as an other dependent,
Oh, okay.
which is only $500. But I mean,
Got
it's,
it.
But when you have older kids, like me, we love this.
Yeah.
We love this.
Yeah.
Okay.
And it can also be used for, again, for elderly parents if you claim them as a dependent.
Right, okay. And this is children up to or including age 17?
the child tax credit is for children under the age of
Under
17.
right.
Okay.
So for any that are older, which
That's the
that for
others are
years has
17 or
thrown people
Yeah.
off. Why isn't it 18?
Yeah. Because
Yeah.
everything else
Just
is 18.
because.
Just to see if you're paying attention.
Yes,
Yeah.
exactly.
All right. Okay, let's take a look at earned income credit. There have been some changes on here as well. So what's changed to start with from 21 to 22?
So I think the biggest change is with the earned income tax credit is the taxpayers that are claiming the credit without having children. That we saw the biggest change. So that one,
Yeah.
the minimum age in 2021, the minimum age to claim the credit was increased to 19 years old. Decreased to 19 years old. And then now in 2022, it now reverts back to 25 years old. On the upper echelon, there was no cap in 2021 to be able to claim the credit. Now, in 2022, the cap on the age is reverted back to 65 years old. So the amount of people eligible to claim the credit from an age standpoint has dwindled a bit. So the maximum credit that somebody with no children would be able to claim is about $560. Obviously, with earned income credit, there are income limitations associated as well, depending on the filing status. So those were the biggest changes. Obviously, there's other things to consider with the earned income tax credit. Obviously, the investment income cap is a big one, right? So essentially, if you have somebody who's not basically making a wage, but they have a massive portfolio, they wouldn't qualify for this credit because, they're not workers. So you have to make sure that they have at least $1 of earned income to be able to qualify, aside from the caps on the income limitations, which are adjusted as well for inflation.
And one of the things that people forget, that when you're doing filing a married filing separate return, this goes away. Married filing separate.
They don't get
They don't get
claim
it.
this at all.
Right.
If you are claiming the earned income tax credit, does that impact your ability to claim any of the child credits? Or you can get them all?
No.
No, not at all. Yeah.
Okay.
Yeah, those are separate credits. Yeah.
And the IRS is very strict when it comes to the earned income. We have to do, paid prepared due diligence checklists and everything, and the penalties for claiming it when you didn't actually earn it. They'll come back on you for that. One of the things, I believe that this is one. People that claim this, which tend to be a lower income, that's what it was set up for, a lower earned income, and those tend to be the early filers. Well, They don't get to receive any refunds. It's an IRS rule that not till, I was hearing late March, or excuse me, late February. Now I'm hearing into March. No refund can go out until March for those people.
Yeah.
So the people that need it,
Yeah.
need those refunds, are not able to receive them as soon as they need it.
Yeah.
And is that just because there is an anticipated high amount of fraud?
It's the fraud.
Yes.
Yeah.
And as a reminder, that is one of the items that comes out on the 8867, the preparer due diligence checklist. So the preparers definitely have to be careful with that. In addition, if you have maybe a client who's potentially working abroad, they don't qualify if they file a Form 2555, the foreign earned income exclusion. So that's also something to be very careful of.
Yeah, we have to be very careful on asking the questions, right? Of
Correct.
having that communication with our clients and not making assumptions. And I think that due diligence form there, it keeps us on track with that. And penalties are pretty hefty if we don't follow the due diligence requirements.
Okay. Let's take just a moment here to hear a word from our sponsor, TaxFile. And when we return, we'll be back with the second CPE code for this session.
It's been 20 years since I opened my firm. I walked out of my corporate accounting job, and I never looked back. I've always known there was more to being a CPA than sitting behind a desk all day. I opened my office so I could help people. I built my reputation and my book of business on my relationship with my clients. I visit them face to face. I see what they're selling. I take tours of their new offices. I see how they're trying to leave their mark on the world. They trust me to help them grow because I don't see them just once a year. When our firm and the clients we serve started growing, it started to change who we were. Just getting through our compliance work meant that I had to choose between seeing my clients or getting the work done. And that's when I reached out to TaxFile. TaxFile gave our team access to a gig network of CPAs to help them with the workload. We send them the projects I don't have time for. And they send us updates in real time as they work through each project. It makes us more effective, more efficient, and just plain happier. I didn't stay in business for 2 decades staying behind my desk. I feel like TaxFile gave me back my purpose. I can give my client relationships the face time they deserve.
We are back. Welcome. And at this time, we'd like you to take a look at the bottom of the screen. And we are displaying the second CPE code for this session. Okay, so be sure to write that down. All right, I believe we had a couple questions coming in from the
We
audience.
did. So the first question is, what is the income limitation where there is no child credit and other credits?
Where there is.
Ignore that second part.
Income
Just
limitation on the child credit and then income limitation. on the
Yeah.
credits.
There are limitations, based on the modified AGI, right? So I think those are great to just go over. I have here the child tax credit. Once you are married filing joint, an amount over $400,000, and that's the phase out. Now, does it completely phase out after that, or is it's I think a reduction? No, it's the $75,000. You are completely phased out, though, right? If you're married filing joint for anything above $400,000, married filing joint.
Right.
okay, and then what is limitation on investment income?
Oh, that was with the earned
That's,
income.
Yes.
10,300.
10,000, yeah, I think so.
300.
So it was 10,000. It was for inflation. It was adjusted up to 10,300. But obviously, if you get over that, then you no longer qualify for the
Yes.
earned income tax credit.
Right.
So that was a great one that came. The American Rescue Plan Act brought in a lot of nice changes, and that's one that some of them were generous that stay in 2021, like the ones we were talking about, the child tax credit and the dependent care credit. The one about the earned income credit with the investment, that actually stayed, and now it just gets adjusted for inflation. So that was a nice one.
Right.
So it is 10,300 for the year 2022.
Okay, and then is the earned income tax credit for 2022 non-refundable?
The earned income tax credit, is it non-refundable for the year 2022?
That's what it says.
I'm not sure. Honestly, do you remember?
I don't.
Well, if any
I believe
of
the
you
earned
know
income
that answer,
credit
please
is
feel free to put it in the-
refundable.
I think it's refundable.
Yeah.
I think it's
It should be
refundable.
fully refundable,
Yeah.
I would
Yeah,
think.
I don't know if there's a
It's a
limit, but I
refundable
know
credit, yeah.
part of it is refundable.
Yeah.
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 I think
It's
you're
just
right,
getting through the
yeah.
limitations, right? That's
Right.
the key,
Yeah.
you know?
'Cause I've had some clients with that.
I have too.
Yeah.
I was trying to
Yeah.
remember
Yeah.
what exactly the details were, the amounts, but I can't remember.
Yeah.
I know with all of these credits, so some of them are partially refundable, some of them are not. Then
Right.
with, the back and forth with 2021 and 2022,
Right.
but
Well,
Yeah.
honestly, I've had the IRS come back to people that I know did not qualify for it, saying that they qualified for it and they received an additional refund. And I still, to this day, don't know why they
How?
did. Yeah, they don't tell them how. They just said you did. So I'm not sure what they used.
That's crazy.
I know.
Wonder if they did the due diligence.
Exactly. I don't
checklist.
think they did the due diligence because I had the support and they did not.
Okay, and then if divorced parent, does the parent claiming the child get the EIC, or does it depend on who the child lives with?
I would say definitely. I mean, if we go into the dependency, right? If the child lived, whoever that he or she lived with for the last 6 months, or more than 6 months of the year. And honestly, when it comes to divorced parents, it's that decree that we were talking about that's in between of who has the right to claim the child according to the decree and the separation agreement.
Right.
Okay. That's all for now.
All right, let's skip over to the federal adoption credit because we're kind of going from young childhood up to older age children. So for the adoption credit, what's the deal with that and what has changed in the past year?
Go ahead.
How does that credit work?
So,
Yeah.
go ahead.
Oh,
Go ahead.
it was
Yeah,
good.
that's fine.
Honestly, it's expenses that you pay for the adoption, and I've looked at the IRS instructions, and it's pretty liberal. Anything that you spend for the process of the adoption, court fees, even travel fees, but the credit is limited up to $14,890 for the year 2022. It did get adjusted to inflation, so basically the same rules are rolling over to 2022, just being adjusted for inflation.
Right, right. And it's important to remember too that credit is also non-refundable. So obviously you have to have a tax liability to be
Yes.
able to get the benefit.
Okay.
The great thing, it can be carried over for
Right.
5 years,
Right.
so that's a nice one.
Nice.
Yeah.
All right, let's talk about education credits.
Well, one good thing is it's actually simplified a little bit.
Yeah.
Most people don't realize that we had multiple credits for the last couple of years, tax credits, but we also had the tuition and fees deduction.
Right.
That went away. We didn't even have that in 21.
Yeah.
So for 22, all we actually have are the two credits, the American Opportunity Credit and then the Lifetime Learning Credit. So it's much simpler. We don't have to do the optimization to figure all of those
Yes.
out. One of the most important things as a practitioner that you need to remember, this is a conversation to have with your parents that have kids that are college aged. We saw a lot of students filing their own returns and claiming themselves over the last 2 years because of the stimulus rebates. They wanted to get that extra $1,400 or whatever it was for the year. So they kind of, and that was a group that did not get those originally, unless they claimed themselves. But if it was a dependent over a certain age, there was a window of kids that you didn't get a credit for. So we saw all of a sudden a lot of kids, college students, were claiming themselves, preparing their own return, removing that dependency from the parents' return. They were also then getting the credits because they had lower income of the education credits, whereas maybe the parents weren't allowed to take them because their income was too high. Now that we don't have those stimulus rebates and refunds coming, we're going to see a lot of parents and kids go back to, wait, are they really supporting themselves? Or, what really comes into play? So that's a conversation that's going to have to be had in planning because it may change things as well.
Yeah. And for those education credits, just the American the American Opportunity Credit and the Lifetime Learning Credit. I think the biggest difference between those two is the AOTC is only available for the first 4 years of that post-secondary, the higher education.
Okay.
Lifetime Learning, no, you can be on your 5th, 7th year and still take it if you qualify for it.
I mean, I can qualify for the lifetime
Yes.
learning.
Yes, you can. Anybody going back to school.
Yeah.
Don't have to be half-time.
Yeah.
Yeah. Okay.
But also, married filing separate, this is another one of those, you don't get the credit.
Ineligible, yeah.
Yes.
Do anybody know what the logic is behind that?
No.
It seems so unfair.
Logic?
Yeah. Logic.
You're so
tax.
funny. Super funny.
Okay. And while we're talking about those, you brought up the former deductibility of tuition and fees. So there's still the opportunity to deduct student loan interest.
Yes.
Yes.
And that hasn't changed. Who gets that deduction, though? The parents who are paying the kid's loan or the child?
Go ahead.
I mean, if we look at the ethical, who is paying for that interest is who has to claim or is entitled to claim that deduction. And so, and I think there are rules on who's the bearer of, the holder of the note and who's the receiver of that.
Well, especially when they started requiring parents to be co-signers on the loan. And frankly, most parents have income that's too high to even be able to claim the student loan interest
Right.
deduction.
Yeah.
And then you also have to think about the 1098E, who was it issued to?
Right.
That might cause a flag and kick the return back with a notice on if you're claiming the interest without there being a 1098E on file.
Yeah.
Okay.
I have a few other comments and
Cool.
questions that came
Sure.
in. Hold on, as I cough. For the divorced one, that question, the person wrote, it is the most of actual number of days a child lives with the parent that controls, not the divorce decree.
Okay. Yeah.
Okay, so I'm going to delete that. Can somebody claim a child that lives the whole year but is not a relative like a grandchild or stepchild? It is just the child of her friend.
Just the
They'd have to be
child
able to
of her
prove that they're providing more than half of their financial support.
And I think it comes to the relationship test, right, for
Right.
a
It
child
does.
tax credit.
It does.
Either has to be a blood, that relationship, or a legally adopted child.
Right.
But they might fall under the other dependent credit.
Right.
If the child claims themselves the last 2 years, can you really just put them back on the parent's return as if nothing happened?
I mean, you can. Yeah, you absolutely can. But what it's going to come down to, they probably shouldn't have been claiming themselves to begin with. It was, what we saw is it was strictly being done because of the stimulus rebate. But more than likely, they did not even meet the 50% support test. So is it going to be a red flag? I don't know if the IRS can even figure that out, but also situations can change. So, but you do have to look at the support tests. Some kids were out of school, some kids were working full time. They took the time off during COVID and didn't attend school. So then they may go back to school. It just depends on the situation.
Can you get an education credit for a certificate program and not a degree? Like a certified end-of-life doula certificate.
Yeah.
If it comes from a certified accredited school, or institution, yeah.
So does LinkedIn Learning count?
I don't think I haven't seen a 1098T put out by LinkedIn Learning, but don't even mention it because someone will try.
Yeah.
So, yeah,
I
let's
know
just not do
there's a
that.
database where you can
Right.
search for the school to see if they are an accredited school or they're
Right.
under the U.S. Department of Education.
Right.
I mean,
It's a
there's
good check.
there's a lot of things with education. We could talk about education forever. One thing that we see a lot of, especially if there's a family business, is that people will, may claim some of that as a business expense.
Right.
You can't double dip. That's one thing. You cannot double dip with any of these. We didn't mention 529 plans or any distributions like that, but that's another thing that you need to be aware of. The same funds cannot be used for a credit where it was also used as the tax-free portion of an education distribution.
Okay.
And then states, there's different states, and we're not even getting into states, but there's a lot of states that have additional tax credits and deductions
Oh, yeah.
for the education plans.
Yeah, yeah.
Is it all right to still go through this list, or do you have questions
go
you want to
ahead.
make sure? I mean, they're like coming in.
They're,
so.
they're flying in. I can see it on the side.
Some of them are a little bit too specific, and it would
Yeah.
probably constitute advice, so we're going to have to skip those. But are the lifetime learning and AOC credits available to the college student if the parent is over the phase out limit?
Goes back
So
to the
presumably
support test.
The student is the dependent.
Right.
Still. Yeah.
We have family-owned businesses who are putting the child on payroll to get this credit. Their wages are then used to show that their earnings are enough to meet their support limit.
Okay, we're not going to get into that.
Nope.
That's
Yeah,
too
that's
much.
too specific.
Okay.
No, yeah.
Moving on. What is the income limitation to deduct student loan interest?
Yeah, there is a limit.
I don't think I have that. I want to say
It's not very high.
it's not. I could be wrong. I want to say it's around 80,000.
That's what
I
I'm
think that's what I
Yeah.
was
That's the
going to
number
say.
that popped up into my
Yeah.
head. I could be wrong,
Yes, it is 85,000 if you're single,
Okay.
but okay,
or 170 married filing joint. You're completely phased out.
right,
Okay.
right. And that's for the people that obviously have been paying student loan interest, because obviously with the forgiveness, those 1098Es have been a little bit missed the
Yes.
last couple of years.
Yeah, yeah.
Okay, more questions. Man, this is an attentive audience. How does the credit for the AOTC work? What is the percentage refundable and non-refundable?
So it's 40%, up to 40%
40%.
refundable, right? So that means that you
Yes.
can get up to $1,000 of the credit, and then the rest is, unfortunately, you can't deduct it, or you can't use it to increase your refund, essentially.
And I don't know if we mentioned this, the lifetime learning credit is
Is
non-refundable.
non-refundable,
I don't
correct.
remember, I don't know if we
Yeah.
mentioned that or
Yeah,
not.
yeah.
How does loan forgiveness play into this?
Well, it's not happening as of right now. And my understanding is if it does happen, it's going to be taxable income. I haven't heard
I think with
otherwise.
the American Rescue Plan Act, if your loan is forgiven by the goodness of the heart of the note bearer, from 2021 until 2025, it's not cancellation of debt income. It's not taxable. But of course, with the American Rescue Plan Act, there was no mandate
Right.
for the loan providers to forgive that loan. There is currently an application where there's a program up to $10,000, right? But it's depending on when you click on the link, it might be blocked. If
It is blocked now.
is
actually.
it?
And then
Yeah.
for those that took out those Pell grants, it's up to 20,000.
Yes.
We'll definitely have an answer by June 30th, which is when the student loans go back into repayment for one, and that's when they've set the date. Obviously the states are fighting this. The federal government wants to make it non-taxable, and the
Right.
states with the limitation of the SALT cap and everything else, they've kind of taken a stance and said, hey, you can't do this anymore.
Yeah.
We can't afford it.
Yeah, that's another rabbit hole, right? If,
Yeah.
if federal
States are
says
big
it's
on
not
this.
taxable,
Yeah.
but then states, they don't have to agree.
Right.
Yeah, they can come back and say, I don't conform. We're taxing that income.
Right.
So yeah, so if you're lucky enough to have your student loan provider forgive that loan until 2025, for federal purposes, it is not taxable.
Okay, last question for now, and then Gail can get back to her other questions, which is on the earned income tax credit. What about an employee working for a U.S. company but working outside of the U.S.?
So in general, it depends. But if that person would have to file the foreign earned income exclusion, which it would be either that or the foreign tax credit, but depending on that person's situation, then they wouldn't qualify because they would be excluding that foreign income that would cause the filing of the Form 2555.
Right.
I'll kick it back to you, Gail.
Okay, sorry for my coughing here. Next thing on our list is the kiddie tax. Kelly's favorite topic.
It's not my favorite topic because most people don't do it correctly or even know it exists.
So let's have a little summary of what this is and what people don't do right with this, don't do correctly with it.
So investment income. You open a savings account or you invest some money mutual fund for a child.
In your kid's name.
Yes, in your kid's name. The kiddie tax comes into play for certain limits, right? If it's the first $1,150 of that investment income, tax-free for the child.
Right.
And then they do have to be under 18 years old. There's so many ages to keep track of, but this one is 18, under the age of 18. Or a full-time student up to 24. And then the next $1,150 is then taxed at the child's ordinary income on that investment income. And then I think we have excess income over $2,300, and that's where it kicks in, the parents' rate.
They tax at the parents' rate.
Yeah.
This
And
is impossible not to do without a tax program. This is almost, it is, because you've got to go between the two returns.
Sure. So, and this is just an opportunity to move income, shift income and lower taxes.
That's the intent, yeah.
So yeah, be careful with the limits if that's the planning strategy behind it.
Yeah, and just to also kind of note is there's also other options for parents to take as well. Some parents want to claim the child's interest in dividends, for example, so then they'll file the Form 8814 to be able to elect to do that as well.
Okay, sorry, I'll get through this. So before we look at some of the other things that we had on our list, I'm wondering if you guys have any projections as to how all of these are going to possibly change in the year ahead. Is there pending legislation? Have there been any discussions that you've heard of about any of these child-related credits?
Generally, depending, because obviously this has also got a political effect too, right? Generally speaking, in the past we have seen where there have been last-minute changes, before the end of the year, or they might kick it in at the beginning of the year. But as of right now, we really don't know. They've obviously done a lot to adjust a lot of these, the tax brackets, the credit amounts, to adjust them for inflation to help. But as far as right now, there's been nothing significant that we know of.
One of the things that is brought up constantly is bringing back the advanced child tax credit.
Yeah.
Obviously, it did not happen in '22, but this is one of the things that's constantly mentioned. We don't know if it's going to happen or not. None of us have crystal balls. I wish we did, but it's this next year. I mean, with what they're having to deal with, we had 45 credits laws that expired last year, December 21, that we're waiting on to find out what's going to happen with those. So, some of these are in there, including that.
Okay.
Yes, yeah, but I haven't heard of anything that's close to being signed by the president regarding the expansion of these child tax credits or the advance payment. So yes, no.
A lot of it has been related to clean energy and something unrelated to the education credits.
Right. But it's an opportunity for practitioners to speak with their clients. You can't give a client just one scenario anymore. You have to talk to them about what the different options are. This is why tax planning is so important. So important, not just to avoid surprises in April, but especially if you're dealing with possibly a student that may file their own return in, January, whenever they open it up, ahead of when the parents are doing it, and then we go to do the parents' return, and we put them on there, and we find out, no, the kid did it themselves, and then it's just a mess mess with everything. So you have to stay in touch with all of your clients to talk about this stuff.
And I think it's never too early to talk to you. I mean, if you have taxpayers that have recently, small kids, college will be here before they know it, and it's best to just prepare in advance for it.
Right.
There's so many tax planning strategies that you can present to them, and that they can at least start thinking about whether, it be a 529, how to pay for college, buy some land, have it appreciate, and then we talk about capital gain rates on that.
Right.
So yeah, there's, it's really the key is communication with your taxpayer client.
And in addition, if your taxpayers have businesses, the questions like you mentioned come up, if you have older kids, payroll and different options that might be out there for them.
Yeah.
Okay, excuse me. We have one more CPE code that we would like to share with you, so please look at the bottom of your screen, and we're posting the last code for this session. So be sure to record that if you're planning on collecting credit. Can you take this for a second?
Yeah, absolutely. So I think we have a little less than 10 minutes left to go. With that time, we finished with the crystal ball. Do we think we know what's going on with that? Okay, so first of all, if you're not living in this day in and day out, how should people stay on top of this?
There are so many wonderful subscriptions that you can sign up for. I mean, it seemed like when we were doing some of our research, we were all pulling up, whether it's Kiplinger or Intuit had some great articles. There's so much information, and all of the larger firms usually put out some very good articles. You can literally go into year-end planning for 2022, and most of these are right there and listed.
Oh yeah. I can tell you my preference on how to stay up with this is listening to podcasts. I'm multitasking, doing chores at the same time as I'm listening to podcasts, and then I'll sit down and maybe make notes and then go and research further. But there's resources out there. I mean, the tax practitioner community out there they're not gatekeepers. They're sharing this information, and it really is, we're all in this together. So it really is just researching and talking amongst your peers.
Yeah, the bigger firms also put out these extensive year-end planning guides that they publish, which are also very helpful, very technical, may not apply to you, but it's another resource that's out there.
And you really use social media. I mean, we mentioned LinkedIn, but there are so many groups out there, networking groups that are, either run by the state society or more specific if you're in, different niches where the practitioners are actually having the conversations, asking the questions, asking more specific questions like you asked, where we can't get into the tax advice portion, but you can usually find somebody that has experienced that.
One more thing we didn't really talk about much, other than you mentioned it, was 529 plans. Just quickly, can we just go over what that entails from a federal and a state level?
Well, there's no deduction or credit for a 529 contribution during the year, but there are several states that allow that. And
is it typically if you borrow from one of the state-sponsored plans?
I'm talking about for money putting in. You can put that in.
Yeah. I don't mean borrow. I mean contribute.
Oh, yes.
Yeah, so for federal, you won't receive a deduction for making a contribution to your 529, but for some states do, like you're saying, Kelly, do allow it. Contributions, they're unlimited, right? You can contribute as much as you want to a 529. You do have to be careful with the gift tax rules.
Right.
We have that annual gift, I think it's like $16,000 for 2022. You can contribute up to that. Any dollar after that, then you have to deal with gift tax return filing.
Do they still have the 5-year rule where you can spread it out? Okay.
That is an awesome. I think so. It'd be like $80,000 that you can contribute,
right? And
it's treated as if you were to spread out that gift annual exclusion for 5 years.
Right.
Yeah.
Right. And another thing to mention for married couples also is that it's 16 per parent essentially, right? So it's not limited to if you're married filing jointly, you can take that advantage as well.
Yeah.
But grandma can do it, or aunt and uncle can
Right.
do it.
Right.
It doesn't have to be for your child.
Right.
Okay. Any last thoughts about taxes relating to family issues?
Find a good resource. Find good resources that you follow and stay on top of it. If there are issues that may impact you, especially from a state side, watch some of these issues if you're in a state where, may not conform with the federal law, and, constantly follow it and then pass the information on to your clients. Don't wait. But at the same note, when you ask if there's anything that we're aware of, as a general rule, things are out there, you're reading about it in all the newspapers. This may be this may be this, until it's more of a, affirmative stance that's going to be taken, or more directions. There's a lot of regulations out there that may be happening. But until it gets to a certain point, I don't even really address it.
Yeah, just having that communication with your clients throughout the year, not be reactive, when it comes to tax time. Meet with them throughout the year. Usually when you meet with the clients, it's almost like you're their therapist. You have these conversations of family changes, life changes that are happening. And so really it's start thinking about your clients and almost like segmenting those younger parents, and what strategies can we propose to these younger parents versus the ones that are getting closer to those college-age students, and leverage that information, the research that you're performing for going across your groups of clients.
I mean, one of the questions I ask every single client in tax planning is, have there been any life changes? I phrase it like that, life-altering changes. Because any of these things, whether it's mom going to work now, then she stayed home with the kids and now they're old enough, or somebody's starting to put money into their education, or dad lost his job, or there's any life-altering thing. So that's something that I just flat out ask every client.
Yeah. Certainly from a moving standpoint, right, you could have additional state filings, and if you don't ask the question, you miss something, and then the client gets a notice and now it's your fault.
Yeah.
Right?
Exactly.
Right. And stay on top of notices. That's the other thing.
And with pending legislation conceivably going to impact some of these things before the end of the year, what's the best way for people to stay in touch with what's going to happen?
Find a subscription source, like we said, and set up some keywords, maybe, so that you can receive notifications through email or whatever your platform is, so that you can see. Don't just listen to Joe Blow or your neighbor's ex-wife's girlfriend's hairdresser, because they probably aren't correct.
Got it. All right. Well, thank you so much for this very informative panel. Thank you so much for being with us today, day one of Ensuring Success 2022. We hope to see you. I will have my voice back tomorrow morning at 9 o'clock Eastern Time for another 7 hours of continuing education. Thank you again to all of our sponsors, and we will see you tomorrow.